Well, it's that time of the year when we get you global and domestic experts on the channel to talk about how the construct for investing environment is looking. Today we are talking about Outlook 2019 with another rare voice on the channel, Prabhat Awasthi, MD of Nomura, to have his views on how things look from here on. Prabhat, thank you very much for your time.
Thank you.
Prabhat, let's start by understanding the global landscape first. We just did see a rate hike by the US after two nudges from Mr. Trump not to go ahead. Jerome Powell did go ahead and hike rates, and even the commentary about the plan from here on was not as dovish as perhaps the market was making it out to be. How are you looking at the interest rate scenario in US now, and how will be it impacting the investing landscape?
So I think the investing landscape actually depends on, is very different from what actually happens, because at the end of the day, people anticipate rate hikes. So whatever you anticipate, and if you get more than that, then it's negative for investments. Otherwise, you know, whatever. So I think what happened in US this time around was that people expecting a bit dovish commentary and sort of didn't come out as dovish. But whatever is there has been now put out, right? So it's sort of two more hikes is sort of put out now. So market has moved in the direction. Incrementally, if things get worse in terms of rate hikes, then that can be negative for the market. But I think markets tend to digest whatever news comes out very quickly. I mean, couple of days, these days at best, couple of days or 3 days or 4 days. So my guess is that I think when you talked about global environment, our overall sense in Nomura is that it'll be, you know, growth slowdown is something that's going to happen globally, in US, in China, across globe. And part of the reason is that you've seen a huge amount of stimulus in the past. Your monetary policy was too loose, sort of getting tightened now. There are trade frictions which are happening. So end of the day, coming from a sort of very, very benign environment monetarily, fiscally, you're sort of moving into the other direction. And that I think will definitely sort of have some marginal changes to growth. I mean, definitely changes to growth on the negative side.
So how do you think emerging markets will actually cope with a slowdown led by US and China? Do you also see a prolonged pause by US Fed in that light?
So I think there's not one simple unidirectional answer to this. I think the important point essentially is that when the growth was good, it's not that EMs were doing extremely well. Part of the reason was that you know, rates were rising and money was flowing to DMs rather than EMs. The growth in US was probably stronger while the growth in EMs was still struggling. And the fact was cheap money was getting over, which was also fueling asset prices in emerging markets. I think we probably, hopefully, we're coming to the end of the cycle next year. To the extent that you can decouple from that overall global growth slowdown. Not everybody can decouple, right? Because you know, every economy has its own dynamics, but there is some amount of global synchronicity as far as, you know, growth is concerned. The overall scenario, I would think, if Fed pauses at some point in time and the dollar starts its long-term appreciation journey, stops that, then I think it might not be that bad for emerging market asset prices.
One of the, of course, big fallouts of this issue or the slowdown in overall is the way commodity complex is actually selling off. Started with crude, which is is meaningfully almost half from 86, and even now spreading to other global metals. Emerging markets, many of them which are consumers of this, of course, get benefited. What's your reading? Do you think it's purely because of the slowdown, or there was generally oversupply? What is leading to this entire commodity complex melting?
The first thing it tells you that you shouldn't forecast commodity prices. Because if you go back to $85 crude, everybody was saying $100, and here we are at close to 50, right? So it clearly tells you that it's hard to forecast commodity prices, and the explanations that come through are always 20/20 with hindsight. But I think slowdown probably is a lot behind that. Obviously supply demand matters, but a forward-looking view of how the supply and demand will interact is what essentially matters in terms of current pricing. I think what's changed, I guess, is demand view has changed, and supply view has surprised. I guess between the two, this has been and especially for crude, right? The global commodity prices beyond crude, actually, if you look at, they were correcting even before that. I mean, steel prices, aluminum prices, copper prices, but not very buoyant, even pre-correction of crude oil. Crude oil separately had a different sort of construct where there was some amount of supply tightness being talked about because of the action of some of the producers. But that clearly there is US which is producing at record pace, and that sort of has dawned on the market, I guess. And then there has been some slowdown sort of talk. But I think by and large, if you look in all commodities put together, then I think demand side has been the main driver of the slowdown.
Prabhat, in your new role, you do a lot of international travel and meet managements, investors. Talk to us about, especially the Asian large economies, the countries we are talking about. How are they talking about emerging markets as a complex which has underperformed hugely? How are the money allocators, analyzing the landscape? Do you think there's eagerness because bulk of their money in the last 2-3 years has multiplied nicely in developed markets? If it starts correcting, are they willing to invest in emerging markets? Are they looking at economies like India closely? Even China has underperformed a whole lot.
So my view is that it's not been an easy ride for anybody, right? Because if you look at it, there was reasonable amount of bullishness in China to start with, and if you look at most of the commentary on India has been that India is a very expensive market, right? Across, last 1 year, for example, and yet here, India has sort of market year to date is still up, while number of large markets are down between 15 to 20%. All Asian markets almost, right? So I think, to tell you the truth, I don't think the initial view of people sort of was that China will underperform so much, and it has, but it has. Obviously, the genesis of this might have been US trade friction, but the data out of China has essentially gotten weaker and weaker, and that has been the reason. And I think the data in India has not been that bad, except the politics news. I think the general underlying data was not too bad. Growth was clearly showing signs of pickup. I think that's the main reason. The investors, I think, I don't think there is a consensus amongst investors that they'll be hugely overweight Asia at this point in time. I think it goes back to the fact that I think it's been a very difficult market to sort of navigate. And as you said, there are two kinds of camps out there. The camp which sort of sees that emerging market has value today, and the camp which still doesn't believe and thinks that market will remain correlated. So I don't think there's an easy answer and a consensus view out there.
Prabhat, let's put the spotlight on Indian markets. Let's talk about valuations first. 2018 has seen its fair share of volatility, both benchmark as well as the broader markets. What's your take on valuations? Because the earning part, while deriving valuation, is just not coming about the way every time the analyst community start the year with.
Okay, let's just say this, that markets have gone up 3%, 4%. What have earnings done? Will they deliver more than that 3% or not? They probably will, right? So markets have gotten cheaper. You might say that it has underperformed the expectation, but they have gotten cheaper compared to where you started the year from. That is, if you expected the market to deliver, maybe 15-20% based on 15-20% earnings, they deliver 3% maybe based on a slightly lower sort of earnings estimate or earnings that they'll come through. So I would say that markets, where they started from, have probably gotten cheaper. But having said that, I think they have also taken the brunt of the fact that the earnings didn't deliver as well as people were expecting, and there were some shocks on the way. And they could be external shocks like oil prices going up and down. There was this whole liquidity shock in the Indian market, starting with the NBFC crisis of sorts, or mini crisis, I should say. And I think the fact that some fears of slowdown have sort of come through now. But having said that, I think when I was looking at our own strategy, I think market is not very expensive compared to history, but just a bit of tad. And I think if you really look at over a time series period, then it would have gotten slightly cheaper because it's sort of not gone up as much as earnings have gone up.
So what's the right way, in your view, to look at the markets? Price earnings ratio, which gets questioned every now and then, at least last couple of years has been the case, or do you think profit pool as a percentage of GDP perhaps is the right way to look at market at the current juncture, where at one point we are looking at some slowdown in 2019, but the crude oil gains from the collapse will also start flowing into the economy.
So you're looking at profit pool as a percent of GDP, you should be a 10-year investor, because it's a very, very broad measure and is not necessarily a signal for markets or performance in the short term. When you go back to history, you will see that when it fell to the lowest point, it was the best time to buy. But falling to the lowest point might have happened over 3 to 4 year period, and you would have gone wrong every of those preceding 3 years if you're looking at a percentage of profit as a profits as a percent of GDP. The P part, I guess, is a derived figure. End of the day, it's derived in many fashions. One is that P should be basically a function of many things, including the growth expectations, including the rates, interest rates that you sort of discount the earnings with, and that keeps changing. The uncertainties in business environment, which of course built in, there's a risk premium that you build for the market, and that risk premium also builds in global uncertainties. So I think P is also an inexact science because it also sort of depends on what's happening in the environment. So if the P falls to a dramatically low level, let's say P falls by 20%, and you look at the environment and see everybody bearish, then you can make and conclude that probably it's in the price. But in a neutral sort of zone, then you have to rely more on earnings growth. Because let's say I'm trading at 10 times earnings, which is not the case, then I can safely say that every bad news is in the price. But when I'm sitting at 15, 16, 17 times earnings, then I can't say that safely. Sure. Therefore, I need to be sure about earnings growth, delivery, to get my returns. I think
so the current earnings outlook at Nomura, coupled with the way 13 to 18, there was a massive run in our equity, which are strong ones, and then there was a bit of correction. The current construct, do you think next 3 to 5 year picture, one can estimate how probably the case is building for?
So I think there
are politics and other issues as well.
So you look at the overall picture, right? I think the 13 environment was very bad actually. So I think if you look at it was depressed more or less because you had a European crisis. Rupee, there was a run on rupee. If you remember that point in time, India was, the weakest fragile five, and from fragile five you went and transitioned to the strong five and stuff like that. Then you again became fragile for a while. So I think it's not that. But when you started with fragile five, the returns, it's counting from low point in the cycle to the high point in the cycle. Like to like basis, returns have been not that great, and rightly so, because the earnings delivery was very, very poor, right? Now, I think, if you really think about a very broad sort of picture, right, what is very clear, I guess, at this point in time is that we are seeing a very long-term sort of recovery building up in the investment cycle. And usually when the investment cycle picks up, the growth rates on a structural basis tend to pick up. Leave aside short-term gyrations, which could happen because of monetary policy, because of the sort of NBSE shock we saw, or for example, oil price hike that we saw, unless it happens on a sustainable basis. The view would be that if the investment cycle is picking up, you are structurally moving to higher growth paths, because investment to GDP ratio, rising investment to GDP ratio leads to higher growth rate structurally. And that basically should mean that you should have a build up in GDP growth, therefore build up in earnings. Compared to past, you should be higher. Then there are one-off factors, like for example banking sector, which was really reeling under NPAs and was bleeding earnings, because not only was there no credit growth, but whatever credit growth was giving you, whatever earnings, it was being eaten up by the NPA situation. That there's a consensus that looks very clearly like it from the numbers. That is reversing, and there's a very large sector in the economy. So if you look at the consumer side, well, it's taken a bit of a knock now, but the consumer side never flagged that much. It was still growing at about 10%, let's say. A volume growth in auto sector or consumer sector was between 5 to 10%. So with inflation, you'll get about that kind of earnings, 12 to 15%, right? So if banks pick up, and the loan growth also seems to be picking up, right? So you should get a reasonable number. Whether that can continue to build on top it depends on so many factors, right? That depends on politics, that depends on global factors. But I think you can safely say that we are sort of coming out of the sort of I would say earnings drought that we've had for the last 5 years, and therefore you should get something out of it in terms of markets.
Let's talk about politics then. Earlier, sometime back when we met, the state election outcome and the way market reacted to it was absolutely surprising. Despite of an unpopular outcome compared what Street was estimating, the market rallied a whole lot. And now we are going into the final event in 2019, which will be the general elections. Opinion is divided whether it impacts the market or should we not analyze it much, or yes, it does. Where do you stand? And because I see you have done a lot of work on what if analysis, on the way scenarios can pan out and the way market will read it. What are your thoughts there?
So in our view, our strategist, that is our equity team, has put out a report saying that they do expect the NDA to form the next election government. But coming to the more fundamental question first, as to whether politics, and there are divided opinions out there. Politics, some people say politics doesn't affect markets in the long term, simply because you have seen what happened in 2004 and what happened in 2014, change of elections, change of government, etc. But markets don't seem to be correlated, if you really look at it. And my guess is that politics does affect. My view is that it does affect outcomes, but in the long term, because in the short term, changing the direction of the economy is just impossible for politics. And I'll take an example, a case in point. In 2014, for example, when this government came to power, we had many moribund sectors, like you had power sector, which is banking sector, which was heading into trouble, because a lot of the loans they had given were now getting sort of implemented and becoming NPAs as sort of years passed. Many sectors like power, roads, etc. were in deep trouble. Oil sector was bleeding, was hiding part of the deficit. And these things take a long time to correct. But you have probably corrected them. The fiscal deficit was running at 6, now down to close to 3. You had massive inflation problem, done. But all these essentially, when you correct these problems, are not necessarily creating growth. They're creating more foundation for future growth. So you might have done the right politics, but not good for votes necessarily. And vice versa, if you sort of start stimulating the economy today, probably there's more room to take that stimulus, because you don't have the macro imbalance, you don't have an inflation problem. So maybe for 2 years you can give a fiscal stimulus and earnings will grow and might not show up in inflation. So the point is that politics will show up only after 2 to 3 years.
With a lag.
With a lag, always does. But it depends also on when you do it. If the economy is already on fire and you give more stimulus, it will definitely lead to a problem, right, immediately. So my guess is that short-term politics, therefore, in that fashion doesn't matter for markets, and might therefore surprise markets positively or negatively, depending on what the case might be, right? My guess is that for next 2-3 years it should not matter that much, because we have gone through a very painful phase of correction in the economy, done number of reforms, we've done a lot of stuff which was very painful to do, and now we're in a sort of more solid growth path. It might not get derailed that easily.
Okay. What's your stand on financials? That's, as you just said, of course, larger portion of the benchmark, but also for the overall economy, and it's got so many variety of stocks listed. You've got corporate banks where things are looking upward. The NBFC space went through a crisis of its own. Private banks, of course, are doing well, and PSUs are gradually some of them are coming out of PCA. How does this entire bunch of the space looks like in your view?
So the overall construct is very simple. If the growth picks up and investment cycle picks up, growth, not necessarily growth alone, consumer growth, not consumer growth alone, but the overall growth and overall credit growth in the systems. You go back to, again, you talked about 3 to 8 period. 3 to 8 period, everybody did well. Private banks, corporate banks, consumer facing banks, everybody did well, because the overall credit growth was running at 30%. Then we had a period when there was like close to zero credit growth, right? And that construct, the market share gainers actually did well, only because NBFCs and consumer facing banks, because there was growth there, but it was just not, there was a portion of economy was deleveraging in that period of time, and therefore the guys who were exposed to that essentially faced NPA issues. If we sort of been there, done that, then hopefully the overall space should pick up. Now, if the growth becomes very strong and goes to 20%, I think everybody will benefit, simply because there's enough for everybody to do. If it remains close to 10% handle, then maybe the guys with funding advantages and balance sheet will probably do better. So I think it depends on the overall construct of growth as to what it does. But I think as the growth strengthens, my guess is it will percolate down to everybody. Now, obviously, if the capital problem gets solved, then people who have not participated will also participate. And the corporate side, which was very, very, which was basically deleveraging, hopefully start coming back with the signs of people, some more sectors participating in corporate capex, more sectors starting to get out of trouble. So I think corporate sector, which was deleveraging, will probably start to at least, well, not leverage up, but at least start borrowing more. They were actually deleveraging. So my guess is that it will be a more even keel cycle compared to very one-sided consumer-facing banks. I think it will become more even keeled. And then it depends on where the valuations are more different.
Sure, of course. How are you analyzing the slowdown in the auto space? You looked at that space in your earlier avatar. Now when we talk to CV companies after a 4-year run, they don't sound as confident as they were perhaps some time back. Maruti in fact has gone on record and cut their 1-year guidance, and tier 2, tier 3 is seeing growth for passenger vehicle, but top towns are kind of peaking up. So different sides, but how deep usually slow growth period comes for auto sector in your view?
So I think if you look at the factors which have caused this, and this is not a micro factor, I think it's a lot of macro factor. There might be micro factors like overloading, etc. in CV's cases. The bigger problem I think has been that India went through from a very post demonetization. There was easy liquidity all over the place, and where did it go? It didn't go into corporate credit, it went to consumer credit, and we got a huge pickup in that part of the economy. NBFCs borrowed cheap, lent money to consumers. Banks did likewise, especially those who were in position to do it. And then we went into a very tight liquidity situation. It could have been because of oil, but the fact is that our liquidity just spun 180 degrees and became very tight situation. That's one part. Secondly, our currency, right? For currency we import, let's say $45 billion a month, right? And you multiplied by 12, we're talking $500 billion. Currency goes down by 15%, talking of $70–80 billion hit. Somebody has to pay for it. Ultimately, it gets passed on to the consumer, right? So there's that hit as well. So consumer's taken the hit of currency. He has paid for it. You might not feel it on a day-to-day basis, but somebody's paying that $50 billion, right? Or $70 billion extra. Commodity prices rise, mark to market with the rupee, goes to the consumer. So consumer has taken a lot of knocks in this whole process.
And that is leading to? That
typically lasts a couple of quarters. Mm-hmm. So it's always surreptitious, but the factors are always, these are very clear factors which should have you sort of wondering a bit as to when the consumer slows down.
What's your take on the global facing sectors in India, be it large commodity players, several of them are in the index, be it the pharma space, which after a very bad patch seemed to have clawed back, but the growth estimates are scaled back. IT, what's your take on these kind of, if global growth slows down, do you think these guys will also get impacted, or is it a safe place?
I don't think there's one answer to your question, because I think, for example, if you look at commodities, right, they are not that dependent on US sort of growth, they depend on Chinese sort of growth, right, because China has been the biggest driver of commodities. That slows down, I think commodity players face headwinds. US, I think, has boomed, and all said and done is running a very low unemployment rate. And anecdotally, we know that there is a shortage of skilled labor in the US. Even though visas might not be easy, but it leads to offshoring and leads to business for these companies. And clearly, from mid-cap to large-cap IT companies are benefiting from it. So it's a different dynamic. And pharma is a very different dynamic again, right? Because it's very driven by what's happened to FDA issues. And it's not even one sector anymore, right? That whole genericization phase, which was golden for every player, sort of passed long ago. Has become a very differentiated market. I think the only thing that connects all these is a rupee, right? So, one can safely say that rupee pass-throughs happen only in sectors where there's pricing power. In technology, in long term, we have seen the rupee pass-through doesn't happen because customers have clearly much more bargaining power. But I would say that. There's no one answer for all, and you have to be very specific, stock specific and sector specific, I guess, when you're sort of making investment decisions.
All right, Prabhat, I'll let you go on that one. Thank you so much for chatting with our channel today. It was always wonderful to have you.
Wonderful to be here.
Guys, with that respect to you.